At the recently concluded seminar organized by the Nigerian Stock Exchange with a keen focus on how to improve liquidity, one of the many speakers, Temi Popoola, Renessaiance Capital MD for Nigeria, shared his best ideas for improving liquidity in Africa's equities market. Tunji Andrews was there and they had a good chat.
There are already structures in place to boost low liquidity in Africa's capital markets. Now, what do you think are the best ideas to strengthen these structures?
Thanks, Tunji. I think there's a few things to look at here, and a few of them we discussed sort of earlier today. Top of the list, in my view, are things like transparency, are things like tick sizes on quotes, on transactions. Other things like just reducing the chances for market instability, reducing costs and fees for accessing the exchange. And I think more complex things like fragmentation of the exchanges, where essentially think about increasing competition for people who are looking to access, markets and exchanges, but then hopefully can have other means to do this like we see in other climes, so that improves and increases competition, essentially. So it's things along these lines that...
Okay, so what do you think the role of integration can play into boosting the liquidity in capital markets in African front?
Well, I mean, I think integration is probably more of a macro type solution, right? Because yes, if you look at the Nigerian Stock Exchange today at 60-something odd billion dollars, is probably not up to the average market cap of a company listed, on the, NASDAQ. So it's quite small, and so you can argue that if you integrate, exchanges and, you sort of combine people, that starts to at least, help you with scale, because the bigger you are, then the odds that there are bigger type capital raises that can happen on your platform, and that just feeds through all the way. But of course, that also creates problems of its own. Problems like, differences in currencies across the regional exchanges, differences in operating standards, differences in rules and regulations that, these exchanges all operate under. And also, you have to also be careful to ask yourself, what exactly are you combining? So in other words, is this really the solution, right? I think we also need to think through.
Sure. So what would you say are the great successes of the ASEA? Or is it just too soon to call successes?
I think first, from where I see it, the first thing is awareness. I think the fact that you have, all of these exchanges, all of these groups speaking with one voice, enumerating the problems at hand, I think has been phenomenal, because it's really created awareness to the fact that A, there are markets, and B, that, looks like there's something real here. So that's number one. And I think also it's helped to shape a little bit of policy. When these people are speaking with one voice, I think they're better able to influence policy, whether it's at some of the regulatory levels or even at sort of the macro government level. So this, in my view, is some of the low-hanging fruits that they've achieved. I think they have very decent long-term goals. One of it is things like integration, which I think is noble. It's worth pursuing. And I think over time you start to see a lot more sort of, down the line type real impact.
Now, with the gradual exit of foreign investors on our market, is it a time for us to start looking at local investors, or is it that the numbers just don't add up?
Well, look, I like to work with numbers, right? If the statistic says that of this big population we talk about, 170 million people, 70% of them are on $1 or $2 a day, there's just no way in my mind that any of these people will think through putting money aside to invest in capital markets. That's number one. And once you start to slice the remaining part of the population, right, whether there are things like a big part of the investable universe got burnt in the recent past, because we need to remember that less than 10 years ago, locals actually drove the market, right? So a big part of the investable population probably has very nasty experiences. And unfortunately, coming into that first cycle, they knew little to nothing about what they were getting involved with. And so you can start to imagine a situation where to convince these people to come back into the same market, it becomes a bit of a tough ask. And so when you start to argue that you want local participation in the market, we need to be careful and just make sure that the numbers add up. That's number one. Number two, let's even assume that they do add up. right? The truth also then is you need to think through resources, right? If you look globally, the issue of retail versus institutional is not a Nigeria-specific issue. Okay, if there is 5 retail investors who can invest ₦1 million each, and there is one institutional investor who can invest ₦5 million into my brokerage business, I'm going to forget about all those 5 retail investors. I will go after the one guy. And this is a problem you'll have all the time, right? Just because of the structure, and we're all rational human beings. And so I think, again, it's one of those where I like not to focus per se on, hey, get retail people in the market. I think there'll be a natural byproduct, right? Once you get your market structure right, you get some of the higher level issues correct, then you might, over time, see the retail people flow back into the system.